Hi traders, and welcome to this Pepperstone presentation where we will explore some of the differences between a trader and an investor. There is no right or wrong answer between the two, and one is not necessarily better than the other. But it is important to know the difference so you can apply the right techniques to the path that is most suitable to you. In this presentation, we will learn about the key differences between being an investor and a trader. We will learn about managing the result expectations of both investment and trading. We will learn about the timeframes that you need to be aware of for an investor and a trader. And we will also learn about whether you can be both an investor and a trader at the same time. Although the same instruments are generally used for both, the mindset and process of a trader and an investor can be very different. Investing is a process setting a longer-term goal to achieve results, and often is regarded as a passive approach. Trading, on the other hand, requires a more active involvement to the current markets, where results and goals are generally set over a shorter period of time. Let's now look at the key differences between investing and trading. As an investor, it is important to understand your time investment. An investor will spend a lot less time looking at the markets and will only occasionally adjust, close, or enter new positions. Investors generally rely on dividend income to supplement the overall profitability of a position. Measurement of results is also very important for investors, as they are measured in months, years, and sometimes decades. Investors generally have a lot more diversification across their portfolio, as there will be more open positions at any given time. And investors are generally relying on the market to increase in value and rarely benefit from a weakening market. Now let's look at the key differences for traders. Again, your time investment is an important difference, as there is a lot more time required to be a trader who is actively in the market. The win-loss ratios are a factor for traders, as the frequency of trades entered and exited are high, which inevitably costs more in brokerage. Traders need to rely on effective strategies such as technical analysis patterns, chart pattern analysis, and candle strategies to make sure that they're actually in tune with what the market is actually doing. A lot more effort is required from a trader navigating the markets. Traders need a deeper understanding of the market, as they rely on a lot more information and technical analysis to navigate uptrends, downtrends, and sideways moving markets. And traders are often not bothered by the direction of the market, as they can benefit in either direction. Now we'll have a look at result expectations. Result expectations are different for investors and traders, as investors generally have a far greater return on one position. As you can see in the example, a position entered in Apple can remain in place for several months before the market shows weakness. For traders, entry and exit points are far more important, where multiple entry and exits are required, even if the trading instrument is going in the same direction. You can see in the example on the same chart how many potential trade opportunities were evident over the same period. Timeframe analysis is also very important for both investors and traders, but the charts they will analyse have very different timeframes. You can see in the example on the screen that a trader will look at charts with smaller timeframes in order to pinpoint entries and make relevant decisions. Investors will still analyse charts, but in timeframes that are far bigger, where the overall health of the trading instrument is more important than the daily movements. We can see here that a round of charts that an investor will look at are around the daily, a weekly, and up to a monthly chart. An investor or a trader, can you be both? Yes, you can certainly be both, but it is important to follow some key guidelines to help you navigate this. Firstly, it is a good idea to have one account for your long-term investments and another one for your day-to-day trading, as this will give you a better chance of treating them separately and making better decisions. It is also important to treat each account and trade differently. Don't let a decision you make in your trading account for a short-term position affect a long-term portfolio. It is also important not to let one position influence another. Don't let a position in a trading account affect the same position in the investment account because of a short-term noise move. It is also important to remember that the longer-term plan for your investment portfolio, unless your overall belief has changed for that position, should not be altered on short-term noise. It is also important not to look at your investment portfolio frequently. Don't look at your investment portfolio on a daily basis like you would your trading account. This can cause you to make irrational decisions and forget the overall plan that you have had in place because of the daily noise. In this lesson, we have learnt the key differences between being an investor and being a trader. We have also learnt to manage expectations of each trading and investing decisions, and managing the result expectations. We have learnt about timeframe analysis and the importance of knowing which timeframes suit being an investor and a trader. And finally, we learnt about being both an investor and a trader, and some of the rules that you need to put in place to make sure that each of them don't affect the other.